Hi, and welcome to the Macro Show. In today's episode, we're going to try to figure out, are the Fed policies going to lead to hyperinflation or a deflationary crash? And when you know how the system works and you understand what QE is designed to do, then you're going to know the shocking truth of what's about to happen. Now, before we begin today's episode, it is Memorial Day, and I want to thank all the American men and servicewomen who have given the ultimate sacrifice to keep our country safe. We honor you today. Thank you, and thank you for being a fan of this show. I'm your host, Steven Van Metre, and where does this view come from? Where does this view of hyperinflation, where is it stemming from? Well, we have to look at the most obvious place, because when people first start getting into understanding monetary policy and looking at all of this data, they stumble upon the monetary aggregate. Let's take a look. And the most common one that people find is the M2 money stock. And suddenly this starts to make a lot of sense to people. Wow, the amount of money is going up. In fact, here it is shown in billions of dollars. In fact, it seems to always go up. And the idea here is real simple. What is inflation caused by? An expansion of the money supply. So it seems very intuitive to a lot of people that, hey, the money supply is growing, so inflation must happen. In fact, we can even take that to the next level, because the next direction people go with this chart is they look at the year-over-year rate of change. And so let's take a look at that. And here we have the year-over-year rate of change of the money supply. And holy smokes, it was up here at 27% year-over-year. It is slowed now to 18% year-over-year. And this is mind-boggling to people, because they just assume that money must be coming out of thin air. It must be printed, because what else would explain the money supply growing if it isn't from money printing? Because after all, when we look at this year-over-year chart, what do we learn? That typically the money supply grows at, we'll just say somewhere around 6% a year. Maybe a little higher, maybe 6.5%, but typically around 6% a year. So what on earth could possibly explain a 25+% growth, or even today at an 18% for April? What can explain this year-over-year growth if it wasn't for money printing? Well, it's really simple. When the U.S. government borrows money, we borrow it from sources, a lot of it from outside the United States. And all the money supply is telling you is what's in deposit in the banking system. That's it. It doesn't tell you anything else. So if money is coming from outside the system where it's not counted, because and this is, again, a U.S. money stock. So we don't go over into Europe and Asia and other parts of the world and say, hey, how many dollars do you have? Because we need to count them. We don't do that. So when you borrow money from outside the system and you give it to people, say in the form of a direct stimulus. Now keep in mind, keyword borrowed money, because all this money that people believe is printed is really borrowed, and you give it to people and they deposit it into the banking system, it shows up here. And that's all so far that's happened. But yet the belief is, okay, well, even if that's true, Steve, even if that is how it is, and it is, still it must be inflationary, because look at all this money piling up into the banking system. It's got to be inflationary. Well, there's an easy way to look at that, and that's to look at the CPI. So let's do that. So if you take the CPI in red and you have the M2 money stock in blue, both running year-over-year rates of change, you notice, well, there isn't that much of a relationship. In fact, there might be more of an inverse relationship than anything, because when the money supply is going down, when it's decreasing, when the growth rate is slowing, inflation tends to go up, but not always. Here there's times here where it's going down and inflation is flat, times when it's going up and inflation is not going up a ton. So there's not much of a relationship here. Now, you can make the argument that in the past, looking at our monetary system before all this, as money would pile up into the banking system, what would that imply? People are saving, right? So let's say I'm saving up for a vacation, right? I'm putting a couple $100 away, and I'm going to save up for a big trip. Maybe I'm going to go, to Disney World or something. I'm in California, so going there, that'd be an expensive trip. Airfare, hotel, parks, food. I mean, it's going to be expensive. So let's say I'm saving up for that. Well, where would that saving show up? It would show up in the money supply. And then when I spend it, the inflation component, well, what happened is I'd pull it out, right? I'm going to pull my money out, buy the plane tickets, buy the park tickets, buy the hotel, pay for all that stuff. And now the money's going to come out of the money supply, although temporarily, because those who are receiving that money, some of it's going to come back into the money supply. But you would get the idea that, okay, saving is inflationary, which would, or saving will lead to future inflation. Now, so that is a valid argument here. So the question is, can all this money get out of the system? And that's where you run into quantitative easing. And then you have to look at this thing called the monetary base, which is where some of this money printing view comes from, because, hey, if the Fed's out buying bonds, they must be monetizing debt. With the exception, there's one big problem. And here you see the monetary base is at 6 trillion, is the Fed doesn't buy treasuries at auction. In fact, the Fed only buys them on the secondary market as a reserve swap. And we've talked about this. If you listen to my Macro Voices interview or some other interviews I've done recently where we break down the system, and I've done it on this show, you find out that the Fed's actions are in opposition. They're not money printing. They're swapping reserves. You say, well, what do you mean swapping reserves? Well, when you deposit money into the commercial banking system, so if you have an account in one of the major commercial banks and you deposit money in there, well, they take that cash and they turn it into what's referred to as a bank reserve. And they take that cash and they go buy generally buy treasury security of somewhere around an average maturity of 3 to 5 years. And so banks buy T-bills and short-term T-notes to back those deposits. And they know after so much time, some of these deposits are going to leave, and that's why they create bank reserves. And all the Fed does is come along and say, hey, we're going to take that bank reserve, that treasury security, or mortgage-backed security, and we're going to swap that with this thing called an overnight reserve asset. That's all it does. So the Fed isn't printing money. They're not buying this at auction. The government's not printing money. They're borrowing it. And so you say, okay, so what is the real issue here? Is how can we get hyperinflation? We look back in the history books, right? We open up the history books and we see, Weimar Republic. Well, they actually did print money. We're actually not printing money. And the evidence of that shows up in this thing called the Money Multiplier. And the Money Multiplier is the M2 money stock divided by the monetary base with an adjustment, so that way we actually have a ratio. And what you see is this ratio has been declining since September of 2019, with this brief exception here in mid-2020. In fact, I was shocked that in April this declined, because what is this ratio telling you? Now, some of you might know I'm not a huge fan of ratios. I don't like taking stocks and dividing them by other stocks to determine ratios. But why does this ratio matter? Because it's telling us one very important thing, that the demand for money, so the demand for money, which is the Fed, quantitative easing, they're demanding money. Does it make sense? Because what is the demand for money? They're demanding that money get into the commercial banking system so they can swap it for a commercial bank, for a bank reserve. So there is a demand by the Fed for money to enter the commercial banking system. It is growing more proportionally than the money supply. And so when you grasp that concept, and then you understand the term dollar prison that I've used in several interviews and on the show, that money now gets trapped into the commercial banking system. Because once the Fed converts those reserves, they can't leave the commercial banking system. Hence, it's a prison, right? So somebody in prison, their whole world now becomes maybe the prison, or what parts of the prison they're limited to. And that's the same thing is true going on here. So if money can't move around, it can't be inflationary. If the Fed's not printing, it can't be inflationary. So money's coming into the commercial banking system and getting sucked in there and trapped. And that's what we see in the Money Multiplier. Now, I did think that we were going to see a big increase in the Money Multiplier in April. Why? Because of stimulus checks. And when we looked, we didn't see that. In fact, we saw the opposite. So with still a little bit of stimulus checks set to go out over May, and I think even going into June, there's a little bit left. What we're seeing here is the demand for money from QE is highly likely to continue growing faster than the money supply, because there is no more fiscal stimulus to help push it up, like we saw here kind of in the middle of last year. And when we overlay the consumer price index, now it starts to make more sense that the money supply isn't the right aggregate to use. It's the Money Multiplier, because the Money Multiplier is telling you that these dollars are getting trapped in the system. Now, let's zoom this in a little bit into more modern era of when we're doing QE. And what you can see very clearly is, even though the year-over-year rate of change of the CPI in red is going up. The money multiplier is going down. And when that starts to happen, it tells you that the CPI is going to adjust lower because, again, trapping money into the commercial banking system is not inflationary. In fact, it is the exact opposite of inflationary. And this is why you hear the Fed say, well, one of the reasons the Fed says that this is transitory, it's going to go away. This is the other reason the Fed can continue doing this without any fears of hyperinflation or high rates of inflation because they know it's going to roll over. They also know that we're seeing a lot of base effects from a year ago. And let's see if we can find them on this chart. And where would the base effects be? Well, they're going to be somewhere right here in this low point. So as these base effects from the formula get worked out, then this headline number is going to come down. But is there somewhere else we can look going back in time to say, well, we see this big drop here. The money multiplier fell as the Fed started to lower interest rates and do QE. But what else happened? Is there something else? And the answer is, yeah, there is. It's crude oil. Now, crude oil or energy is a large component in the formula for the consumer price index. It's not the only thing, but it is a very volatile component because if you've ever filled your car up with gas, then you certainly know that prices can fluctuate, whereas other things don't tend to fluctuate near as much. And if we go back into the great financial crisis, what you see is oil prices were skyrocketing up to almost $150 a barrel, and then they came crashing down. Now back then, we see this inflation, and we saw it. Here it is. Here's that inflationary number. CPI was running up here over 9%. I'm sorry, over 4%. I'm looking at this side, it's over here. Looks like it was running over 5%. And now we see the same fears as, okay. And then all of a sudden those fears got unwound as oil prices came back down. And if we start to look at, is this possible? Is there a relationship here? Oh yeah, there is. Let's go back to our charts. And you'll see that here is a chart of crude oil in dollars per barrel against the consumer price index. And you can see, wow, there's an interesting relationship here that higher crude prices tend to lead to higher inflation. And when crude oil prices start to stagnate, well, then you see inflation start to trend lower. But look at this, crude oil prices are getting stuck around this $66 to $68 a barrel, and the CPI is up here. Again, indicating these base effects are having a big play in the formula, but also indicating that, well, this means that likely the CPI is coming down. In fact, if we look at this from a year-over-year effect, we zoom in, we can see, looking back at the last 12 months in crude, that unless prices start to move a lot higher, that as the calculations from a year ago work themselves out, that the year-over-year number should drop. And are we seeing that? Well, we sure are. You can see that right here. If we take crude oil and we do a percent change from a year ago, and let's zoom this in, you see here crude oil fell back in the GFC on a year-over-year basis, and the consumer price index came down. Now, I know it's a little hard to see, so let's zoom in. And what you can see now is a year-over-year rate of change for crude oil is coming down. And what does that tell you is likely to happen for the CPI? So you can see year-over-year rate of crude oil headed down, CPI headed down, year-over-year headed up, CPI headed up, and now look, the year-over-year rate of crude oil is headed lower, indicating that this inflationary bubble that we're seeing is more transitory than anything. Now, what gets really interesting is if you understand the what and why that we're doing this. So now at this point, there's your shocking truth. You kind of realize that, no, we're not going to see hyperinflation, and these high rates of inflation, very, very much transitory. In fact, likely to lead into a deflationary bust because of the money multiplier. And that's why I want to come back to this money multiplier is probably the most important indicator here. Is it's telling you, look, dollars are getting trapped in the financial system. They can't leave. They are disinflationary and will lead to outright deflation if the money supply isn't growing fast enough. And since the money supply has pretty much been entirely growing here due to fiscal stimulus, and that is done, almost done, and not likely to be seen again for a long time, then what we know is financial conditions are going to tighten, and the money multiplier tells us that the probabilities, because that's what investing is about, is probabilities lie with disinflation or deflation. In fact, the probabilities far outweigh the opposite of higher hyperinflation. Because when you understand the system, and this is key, is how does all this really come together? Well, the United States dollar, the US dollar, is the world's reserve currency. And part of being the reserve currency, it greases global trade. So dollars need to leave the United States and get out in the global economy. How do they do that? Well, when U.S. consumers and businesses spend money abroad, preferably borrow money, which is a creation of money, and spend it abroad out into the rest of the world, buying through goods or services or travel, dollars get into the global economy. And then they can multiply there. And you say, well, how does that happen? Well, think of it this way. Let's say a purchase order gets into a foreign company's hands to build a good, and they need some raw materials, and a lot of raw materials are transacted in dollars, particularly crude oil. So how do you get dollars if you don't have dollars? You go to the bank and say, hey, bank, here's my purchase order. I need dollars. I need a dollar denominated loan. And boom, dollars are starting to get created into what's called the euro dollar system or the foreign banking system. Now, as all these dollars start to grow, and those goods come back or services come across to the United States, how do they get paid? How do they invoice in? Dollars, right? If you're in the United States, you do not pay in other currencies when things are delivered. You pay in dollars. So now dollars come back. There's more dollars going back overseas. And so as dollars build up in a foreign country as a reserve currency, it creates inflation to them, domestic inflation to this foreign country. Now, how does that get solved? Really simple. As those dollars build up, they get swapped over to the foreign central bank, who will swap those dollars back for local currency. And when the foreign central bank or government gets too many of them, they will take them and they will buy U.S. Treasury securities at auction. And because a Treasury security is inflationary in the fact that it pays off a tiny little bit of interest versus having a big stack of dollars, you can tamper the effects of inflation real quick. And those dollars get cycled back into the U.S. Treasury, who then spends them out into the system, and then the system cycles back and forth. Now, when the system breaks, see, now that you understand how the system works. So how do you get inflation? Well, when the U.S. economy, when U.S. consumers and businesses are demanding foreign produced goods and services, you get dollars moving out of the United States into the foreign economy. They start multiplying, and then you get inflation. That's where inflation really comes from. It's not so much from the U.S., it's from outside the U.S. So when the global economy slows, what happens? Well, foreign governments and central banks buy less Treasury securities. In fact, if they have a dollar shortage from a slower economy, they will sell down their Treasury securities because they need to get dollars. And so we think in America, a lot of investors go, oh, well, when foreign governments and central banks are selling their dollars down, that's really bad. Well, it means interest rates are going up. And no, it means just the opposite. It means financial conditions are tightening. It means the global economy is slowing and they need dollars. Now, they don't want to do that. Ideally for them, if the global economy is growing, they will buy more and more Treasury securities. That's how the system's designed. So when the global economy slows down, how does the Fed fill it in? Well, someone needs to buy these Treasury securities. And so you're saying, aha, see, now we're going to come back to the Fed buying bonds. The Fed can't do that. I just told you, it's a reserve swap. They can't do that. So you have foreign governments and central banks unable to buy more because there's a dollar shortage. And Americans hate buying debt, right? I mean, you don't hear people going around talking about, man, I can't wait to go buy some more Treasury securities. No, they want to talk about the latest stock or something else they're buying, the speculative investment. So how do you force Americans to buy something they don't want to buy and not realize they're buying it? That's what QE does, remember? So again, Americans deposit money into the commercial banking system. The bank creates a bank reserve out of it by swapping that cash and taking that cash and buying a Treasury security to back it to pay interest on the deposit. And the Fed comes along and swaps it and locks it into the commercial banking system, that dollar prison. And so what the Fed is doing is forcing Americans to do something they don't realize that they're doing, which is buy U.S. debt. And until the U.S. economy and the global economy recovers, the Fed can't stop doing what they're doing. And a lot of people think, oh, no, the Fed can continue, is going to have to taper. They're going to have to stop. They can't. If you really want them to stop, there's one really simple way to do it, is get the federal government to spend less money. Now, we know that's not going to happen anytime soon. But that's the key, is all the Fed is doing is forcing Americans to fill in the piece of buying U.S. government debt that foreign governments and central banks do. So when you understand this whole picture now, and you understand how the monetary system works, and you understand the money supply doesn't really matter here, that the money multiplier is important, and that crude oil. So watch where crude oil is going. That year-over-year rate of change headed down tells you that inflation, transitory, and most likely going to have a replay, just like we saw in the great financial crisis, where we're going to see disinflation or outright deflation. And if you invested back then, you already know the answer. There's only a couple safe places. It's dollars, which no one wants to have right now, and U.S. Treasury bonds, also something no one wants to have. But when you get a dollar shortage, those are the two things that go up. Everything else comes down, because disinflation and outright deflation, which we already see, the probabilities are there. We know it because the money multiplier here tells us so, that we know the outcome is a deflationary bust. And now you know that not only is this inflationary boost transitory, it's going to flip and roll over, and no one's going to see it coming, but you now know. Anyways, thanks for being a fan. We'll be back with our regular scheduled shows on where I'm dressed up appropriately back on Wednesday for the macro show. I look forward to seeing you then, because we've got a lot of data coming out this next week. Don't want to miss that. I'll see you then. I'm Steve Van Metre. Bye now. The content of this video provides educational information only, and not intended to provide investment or other advice. This channel is not to be construed as a recognition or solicitation of buyer selling a security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. Business expressive video that I do not reflect the view of Atlas Financial Advice Inc. or Steven Van Metre Financial.